Okay, well, thank you, Brent. It's a pleasure to be here. I'm in the FCC Calgary office today. A bit chilly out there, but really happy to be talking to everybody about the upcoming year. Now, I'm not going to try to pay too much attention on the chat box, so I'm not going to be able to address some of the questions you may have. But I'm hoping, and actually my commitment is that we make enough time at the end to be talking about some of your questions and comments and have a bit of a discussion, which is one of the advantages that we have here in this webinar. So what we did at the beginning of the year is we launched about once a week, we launched a blog post on our website. It's, if you go to fcc.ca/ag economist, you'll be able to read one post a week about five trends that we believe are, or five economic trends that we believe are the most important to monitor in 2017. I would like to do is to talk about these trends, but one of the options that I had was to actually go and list down the trends. But what I did do instead, or was planning to do, is to actually go and build a storyline around these five economic trends. So we have the Canadian dollar, oil prices, interest rates, the world economy, as well as commodity prices in general. So in terms of a storyline, what I would like for you to keep in the back of your mind as we go through this is, first of all, we're going to start very broadly. We're going to look at the macro, what I call the macro environment. So things that I believe have an impact on the bottom line of agricultural operations, but not necessarily directly related to. So I'm thinking, for example, of interest rates, the value of the Canadian dollar, and then we're going to dive into the operating environment. I'm not going to have time to go across sectors and really give you a broad or a detailed outlook of all the sectors out there. So I'm just going to cover a few, but I'd be happy to answer any of the questions with regards to other sectors if at the Q&A period. So keep that in the back of your mind. We're going to start very broadly, and we're going to dive in. I apologize for my voice. I'm fighting a bit of a cold, so that's not going to stop me, however, to try to get you excited about 2017. There's a lot of things that we need that we can get excited about 2017 if we set aside what I call the noise around a few issues, right? And I'm listing some of these issues right here. So we got a U.S. election, we got a new U.S. administration now in place, and it's been a fast start to a new policy agenda in Washington, and so that created a bit of anxiety, I would say, in terms of what kind of policies are coming up, and so we'll address that a little bit later on as well. One of the things with China is I think everybody by now know the importance of China in terms of their importance in the ag markets, but we keep reading about or hearing about China slowing down or their economy slowing down. So is this something that we should be worried about? The UK is just getting ready to get out of the European Union and get the process started to formally exit the membership or get their membership terminated with the European Union. And other countries are facing an election as well. Other governments in Europe are facing an election. And this discussion of the future of Europe is always in the back of our minds, as is being discussed quite a bit in the news. And at home, if you look at our own economy, we're still feeling a bit of the impact of the slowdown in energy prices. So what is noise and what is actually relevant to monitor in 2017? So let me start off with our own economy. So 2017 forecast for gross domestic product from the Bank of Canada is 2%. So is this good? Well, not necessarily. It's not bad either, right? So not good because if you look at the average of the last 50 plus years, we're right around 2.75%. So we're looking at growth, economic growth in Canada that is below average, but not necessarily bad either because that's a low way from zero, which would be stagnation. So the economy continues to grow or is projected to continue to grow, but at a pace lower than average. What are the reasons behind this? And I'm not going to get too detailed about the past because really today it's about being forward-looking and looking at 2017. But one of the things that really has had an impact on the economy in Canada is the slowdown in the energy price or energy prices, or the slowdown in the energy sector. Uh, I often get a question, what will happen to oil prices? Well, my response is usually that, well, $50 is the new $100, whereas before oil prices were above and below $100. And depending on where the market was heading, then you'd see a lot of forward sales, and that would bring the price back down under $100. Now I'd say that $50 is sort of playing the same role. Now, some of you may think, well, did we just hear that the oil exporting countries are going to cut back production to sustain higher oil prices? Yes, absolutely. I'm less convinced that their commitment is credible. I actually think that, if they're successful at lifting oil prices, well, then everybody, or all these oil exporting countries, have an incentive to actually produce more and sell more. And collectively, that brings the oil price down again. So, and then on top of that, the U.S. is still, if you look at oil rigs in the U.S., that's climbing up slowly. And so that means that U.S. production is getting online again. And so at one point, I just don't expect, unless there's a significant change in the balance between supply and demand, I just don't think that we're going to see an oil price move up significantly. So our forecast for oil prices is around $50. One of the big hurdles as well to get the economy going is the weight of debt that consumers have to carry especially when you compare it to disposable income, right? So quarter after quarter, we're reaching record highs in terms of the debt to income ratio in Canada. And that's will become a drag at one point. I mean, consumers have actually done that part in getting the economy going. It's just that we can't ask more of consumers. So, we have slower consumer expenditures probably in the future. We have still business investment that's not necessarily going full pace. And so that's the reason why the economy is still not going, or not projected to grow at full pace. So what are the implications of all of that? Well, first off, we can look at interest rates. This is something that one of the questions I get most of the time, every time I'm in front of customers or in front of producers, what about interest rates? Well, with an economy not growing full pace or full speed, it's hard to see a scenario in which you would see the Bank of Canada lifting their key policy rate, right? So if they keep the overnight rate constant, which is their key interest rate that they control to set monetary policy. So if they keep that rate constant, then because that prime rate would not move up again. But I think it's important to make the distinction between the Bank of Canada rate and borrowing costs, which is I would say the most important indicator when it comes to interest rates, right? So businesses, operations don't necessarily borrow directly from the Bank of Canada. So what you have up on the screen is actually a line that gives you the pattern in average borrowing costs in Canada. So it's a mix or an average of different interest rates, different loan products out there. So fixed term, or fixed rate, variable rate, short term, long term. So it's really a mixed bag of everything that's out there. And when you average them out, you see the pattern in average borrowing costs. And for all of 2016, borrowing costs were coming down. And actually, at the end of 2016, close to the end of 2016, we reached a record low when it comes to borrowing costs that businesses face. And we do expect, that's what the blue shaded circles are for, we do expect the average borrowing costs to climb over 2017. Now, we're saying borrowing costs are going to go up. You also have to notice that at the end of the day, what we expect at the end of 2017 is for borrowing costs to be where they were at the beginning of 2016. So we're not talking about a major increase in interest rates, but we're definitely seeing interest rates, especially on long-term loans, climb up a little bit. And actually, you can start to see that on the far right where that blue line ends. You can see a little bit of an upward trend when it comes to borrowing costs. Not much of a trend right now, but we do expect that to continue throughout 2017. Now, what's the driver behind this? I would say that's mostly driven off what is going on in the United States. Right or wrong, there's a lot of optimism about the economy there. The interest rate, the central bank in December actually lifted their key policy rate once again. And the expectation is that we're going to continue to see the central bank in the United States lift interest rates for the 2017, which brings up interest rates in our market as well because we have integrated financial markets. So really expecting interest rates to move, borrowing costs to move up. That's despite the fact that we don't expect the Bank of Canada to lift that key policy rate. So expect prime to stay where it is. Small chance to see it come down if indeed the Bank of Canada would say, hey, we need to cut our policy rate some more because the economy is not picking up any speed. Don't expect that to happen. Expect prime to be constant and expect those longer term interest rates to move up slightly. So something for you to think about, especially if you're at the in a situation where you have a lot of your book that is exposed to floating rates. Maybe something for you to think about in terms of getting some risk or taking some risk off the table when it comes to sometime in 2017. So don't pay attention only to what the Bank of Canada says or what is reported to do, but also pay attention to interest rates in general and talk to a financial advisor about this if this is something that's important for you in 2017. The final macro trend that we have to be thinking about is Canadian dollar. You'll see later on when we talk about profitability in the ag sector, the Canadian dollar is absolutely a critical piece or a critical driver of that profitability. Our forecast for the year is 75 cents. I have to say that if I'm looking at all the forecasts out there, we're probably the upper range of all the available forecasts. So if I were to say, I still think that the average value of the Canadian dollar with respect to the US dollar is going to be 75 US cents. But if I were to answer the question, well, do you think there's more chance to see it go higher than 75 or lower than 75? I would say lower than 75. And again, the reason being of what is going on in the United States. Don't want to get too technical here, but all the talks around the discussion around border tax adjustment and all of that could lift the US dollar and hence lift the US dollar against all the major currencies, about which the Canadian dollar. So we're still good. We're still very comfortable sitting at 75 cents for the year. And I think it's a very positive trend actually for Canadian ag. And I would say that there's more downside to this forecast than upside when thinking about a potential increase in the Canadian dollar. But we'll get to that later on when we start to understand, try to understand the impact of the Canadian dollar. But just keep that in mind, 75 cents for the year. We need to talk about trade. I would say that of all the questions recently that I got, I think the issue of what is going on with the U.S. has been top of mind for a lot of people. Actually, we just taped a small, short podcast available on our website. And that podcast that was released on the inauguration day got the most downloads of anything that we ever done at FCC in terms of sharing knowledge. So that means that this is necessarily absolutely something top of mind for most people. I was debating changing the headline that you see up on the screen because I really do think that I don't want you to think that what I mean by this is that if anything happens at the border between Canada and the U.S., that we would see Canadian farm income drop by 30%. That's not the point behind the headline. The point behind the headline is that just to realize that everything that we export to the U.S., just for ag commodities, I'm not even including food in all of this, well, that represents 30% of Canadian ag GDP, so Canadian farm income roughly. And this is something that, if we were to shut the border, don't think this is going to happen, but if we are to shut the border down between Canada and the U.S., then we would start exporting elsewhere. Our imports from the U.S. would also come down, so that, we would see a 30% drop. But I think the 30% figure is to actually just emphasize how big of a deal trade between Canada and the U.S. is for our industry. And I do think, I'm actually fairly confident that at the end of the day, we're not going to see, if indeed there's a renegotiation of NAFTA terms, or whether the U.S. gets rid of NAFTA, then we fall back on what we had before, which was the Canada-US trade agreement, CUSTA, that whatever happens, I think we're likely to see the border remaining fairly open and fairly few changes when it comes to our sector. Now, not to be said that we couldn't see changes for other sectors, softwood lumber and auto and a number of different sectors, but for ag, I just don't think we're going to see a lot of changes at the border. Uh, TPP is passe. I mean, it's something that's never going to see the light of day without the U.S. leadership, and the U.S. has been quite clear that they're getting out. So what's the fallback for us? Well, we do have negotiations with Japan, so we could go and leverage whatever we've got from TPP and try to use that as a basis for the negotiations with Japan. The entire Asian continent is trying to develop their own TPP in some sense, right? It's called RCEP, RCEP, and that could come back and be mentioned a number of times. So 2017 is likely to be a year where we're going to see what next for Canada. And that's going to be really interesting to see where we're going to actually push for market access, because as I said, I think trade is actually a big driver of profitability for our industry. So, but I think, TPP not seeing the light of day may look to be negative short term, but long term, if we get access to Japan, which is a premium market for us, with nothing to fear really in terms of Japanese food products coming in, I think that would be actually quite a positive story for us. So I think not everything is lost when it comes to trade with because of the new U.S. administration. Now, the three policies that I like, that I will monitor throughout 2017, one of which is left-hand side, country of origin labeling. We fought that battle. We won the battle, the trade battle with the U.S. That policy was dismissed and repealed. There were a few mentions, especially prior to the election, actually. There were a few mentions of actually trying to bring that back into play and push for our country of origin labeling again of some form. In the U.S., the ag industry in the U.S. doesn't want it. Aside from a few states on the border that are pushing for this, nobody wants it really. So I don't expect it to come back, especially given that we won that trade battle, and that's been a really positive news for us. Don't expect that to be coming up again. But having said that, this is certainly something that I would monitor if the discussion would pick up. The relationship between the U.S. and China, absolutely something to monitor. China now such a big deal when it comes to world markets. If you think of, it imports 60% of all the soybeans that are traded in the world. The Chinese market was a big driver of profitability in the pork sector last year, despite the major slowdown that we've seen in the hog sector at the end of 2016. If it was not for the Chinese market, things would have been a lot worse here in Canada. So China is such a big deal. And it is now, so if the U.S. goes ahead and actually does something to address the fact that they labeled China as a currency manipulator, so are we going to get caught in a crossfire, or are we going to be able to backfill some of the sales that the U.S. could lose? Right, so big question marks. Not so sure that there's an obvious answer at this point, but certainly something that I will monitor over the course of 2017. And finally, the ethanol mandate in the United States is absolutely something to monitor. The new president has surrounded himself with ministers, cabinet people that actually been very vocal in the past, not under their new roles, but in the past have been vocal about or against the U.S. corn ethanol mandate. I actually think this is pretty safe, but if we were to see any change there, that could have some implications, obviously, given that 40% of the U.S. corn supply goes into the production of ethanol. So something to monitor. Again, don't expect any changes. I don't expect any changes in 2017, but this is something that I think is worth keeping an eye on. So if I'm so aside now from those macro things, now I'm going to use the next 20-25 minutes to discuss the specifics of the ag markets, right? And I'm putting a question up here, right? Are we seeing the beginning of a new cycle in agriculture? So one of my favorite charts is this one here. And hopefully you can make out the commodities on the left-hand side. But what this is basically is this a red bar means a price right now that's under the 5-year average for that particular commodity. Right? So you start with corn in US dollars at the very top, and you go down the list. The green bar means a price that's above the 5-year average right now. So a lot more red and green. One of the things I'm going to point out is start at the top again, corn in US dollars, and look at that drop, more than 35% drop in corn prices relative to the 5-year average. You're going to pick up, if you go right in the middle, you're going to pick up corn in Canadian dollars, about 10% drop with respect to the 5-year average. So what explains the difference between corn in US dollars and corn in Canadian dollars? Well, some of our own market for sure. I mean, basis levels are not just a function of the exchange rate. There are some dynamics between supply and demand here in Canada that are different between Canada and US, but I would say that the big difference is actually the movement in the US dollar with respect to the Canadian dollar. So you go to the bottom of the chart, next to last bar shows a green bar for the US dollar. So that means the US dollar appreciated roughly 17% compared to the Canadian dollar over the last 5 years. And so, excuse me. So if you add up that green bar to the Canadian corn price, then you can almost get back to the corn price in the US dollars. The bottom line is we've been shielded by this decline in the Canadian dollar over the last few years. And that's been a positive thing. Now the pushback I have, and I totally understand it, is this, well, with a lower Canadian dollar, JP, our inputs are more expensive. And I get it. Absolutely. It's very true. But at the same time, there are some farm inputs that are priced in Canadian dollars. Think of land, labor, so on, some equipment. And so at the end of the day, we benefit from a lower Canadian dollar more than it costs us. And so I want to make that clear because you'll see some simulations later on that will speak to that. So what's the income prospect at the farm level? So this is just to give you a little bit of, or sharing some of the tools that we have to be thinking about the environment for agriculture. So every 3 months, we basically roll out a forecast of farm cash receipts, farmland values, and all these things that matter for our customers and producers in general. And so this is the forecast that was done June 30th of 2016. So roughly 7 months back, 7 to 8 months back. And you're seeing that 2016 and 17, we were saying, things are going to be leveling out. And we tend to lose sight of that. We've had tremendous growth for 10 years, right? If you look at 2005 to 2015, we added more than $2 billion worth of farm cash receipts every year on average for 10 years. So that's more than $20 billion of farm cash receipts for 10 years. So it would be unrealistic to expect that the next 10 years are going to look like the past 10 years. And so what we were saying is, making some, looking at future prices, making some assumptions about yields and production and so on. We're saying that, farm cash receipts are going to level out, which to me is actually a pretty good news. Like I said, unrealistic to expect the same kind of growth over the next 10 years that we've seen over the past 10. And if we can maintain and sustain the farm revenues that we've had in the short past, for the last couple of years, I think it's a good thing. I think it's actually positive. So move forward now 6 months is our same forecast, but December 31st. So that's the most recent forecast that we have. You can see the dark green bar now being lower than what it was. And so basically, because of some of the issues in the prairies with respect to poor yields, weather issues, poor quality, and so on, a weakness in the last 6 months of 2016 when it comes to the livestock sector. So because of this, we are seeing our farm cash receipts forecast coming down from what it was 6 months ago. But yet, it's coming down. So we expect 2016 farm cash receipts to be down, 3 to 4% from 2015 level, maybe a little bit higher than that, who knows. But the idea, though, is that we're still doing fairly well. If you compare the farm cash receipts of 2016 to what it was all the way back to 2005. And again, the key when it comes to farmland values, and I don't have anything very specific to farmland values, do expect farmland values to be able to sustain the large increases we've seen in the past few years. given that we expect farm revenues to be maintained and be sustained. I think that's the key. If any time I've been asked about farmland values, my answer has always been, well, as long as we maintain income, we'll be able to maintain farmland values we have in the marketplace. That's really the key moving forward is are we going to be able to maintain income? And so you'll see that the conversation from now on is going to shift over pricing then to volume. Because from a pricing standpoint, I'm going to argue that there's not a whole lot of upside on the pricing, right? So if we're going to maintain revenues, it's going to have to come from volume. So that's sort of the story that I'm building here. So, but overall, I think for farm cash receipts, pretty positive outlook in terms of being able to sustain farm cash receipts in 2016 and 2017 as well, given that what we're looking at. I want to point out, what we wrote, this was released, our outlook for farm assets and debt was released in September 2016. I think this is still very relevant. Some of the key messages in the report, strong financial position still, but there's some potential headwinds as farm income flattens and land appreciation slows. And those messages for that September 2016 report that you'll find on our website still, I think, are very relevant. And then there's some other key messages in terms of like, what is your working capital position, right? Because if you're going to face some headwinds in the short term, then that's going to be, working capital positions is that first line of defense when it comes to actually being able to navigate an environment where there's a bit of pressure on profitability. And we're actually just as a heads up, I suppose, we're just working on launching a series of long blog posts in March of 2017, so about a month from now, on the financial health of Canadian ag. So just stay tuned and go to our website to actually read a little bit more about that. So as I said, so where I'm moving towards in the next 10 or 15 minutes is really on the profitability standpoint. Let me get to pricing first. I have grains and oilseeds here. The story is actually quite similar for livestock. It's a supply-driven market right now. You got strong upward production trends globally. You got some good weather, some issues in South America right now. But given that we have so much production, and that for a few years now we've had production exceed consumption, I would say at least for 3 years now, that puts a spotlight on the strength of demand and weather. Right? So unless there's a major weather shock in one of the big producing region in the world, just don't see a lot of upside for pricing right now. The good news, I don't want to I think we need to emphasize this actually, is the good news is that the strength of demand is actually very, very high. We have a strong demand for the commodities that we sell. Our $1.75 really helps as well. But, we got some quality issues. We'll get to that, in terms of crops for 2016 that we are going to have to deal with, throughout 2017. And there's just very little upside for pricing. So what does profitability look like under these conditions? So I'm going to start with the prairies, and I'm going to look at Central and Eastern Canada in just a second. So this is a benchmark tools that we use that are available actually. If you're in the prairies, you can go to the SAS Department of Ag and actually look at their enterprise guides and do a similar type of analysis. So using some assumptions about marketing decisions and future prices and so on, you can get profitability for the different crops. The profitability is the distance between the black line and the blue bar, right? So if you have a bit of space between that black line and blue bar, that means profitability is positive. And so you're seeing a bit of tightness, right? For some commodities, wheat's an example, durum and barley, but that's under fairly standard assumptions. That's under yields, or standard yields, or average yields, I should say, and average quality. But we know quality is going to be down this year. So this is 2016. This is for the 2016 crop that's going to be marketed for part of 2017. So if I address these quality issues, because we got a lot more crops that is of lower quality right now in the prairies, you can see that puts a bit of stress on some operations that have poor quality grains. So, the wheat, durum, and then the profitability for lentils is a lot less than what you've seen in the previous chart, just because of those adjustments. So it would have been a good year if it was not for quality issues and yield issues as well, right? Are we going to be able to market that crop that's still in the field? So, that's a question that all operations are going to be different and they're going to have a different answer for. But that's certainly something that we're going to have to live with, throughout 2017. Now, if I'm keeping an eye on 2017 now, this is the picture for 2017. And in terms of profitability, it actually looks kind of similar to what a normal year would have been in 2016. Right? So if you assume that we would have had a normal year in 2016, year would have been actually quite positive in the praise, and we would have had some decent profitability. When I put at the bottom of the chart those red arrows, they're actually related to the estimates that AFC put out when it comes to first set of projections when it comes to acres in 2017. So anticipating an increase in wheat, lower acreage for durum. I could actually see durum acreage would actually be lower than the 15% that we're seeing up here. Canola up, peas fairly flat. Spring wheat up. 6% seems high to me, but hey, well, this first set of estimates, we're going to learn more throughout the year. So that's good benchmark, good baseline to actually start with. But profitability looks decent, especially on the oil seed side of the marketplace. And again, that's because of strengthened demand, really. But when I was putting together this chart, I was like, oh, well, I'm not too happy because 2017 actually looks quite similar to 2016. So what I did was, let's investigate the role of the Canadian dollar. I did mention at the top that the Canadian dollar plays a major role when it comes to profitability. So what I did is look at the 2017 crop, make some assumptions with regards to cost of production. So I'm using some fairly standard assumptions about operating costs and fixed costs. Make some assumptions about yields as well. Yields would be average quality, or quality that we've seen, average quality that we've recorded over the last 5 years. Yields have been just adjusted slightly upward to factor in a productivity gain that we're seeing over a long period of time. Making some assumptions about farm input prices that are remaining fairly flat, maybe just slightly up for some specific inputs, but fairly flat otherwise. Making some assumptions with the Canadian dollar at 75 cents, which is what you're seeing up here, and using future prices to actually tell me about profitability on a per acre basis. So, a fairly efficient operation would probably be able to get more than that $75 an acre for canola right now, and maybe top that $100 an acre in Saskatchewan, for example. But having said that, this is just a benchmark, right? And so what happens now if we start moving the dollar away from that 75 cents forecast that we have? So that's what it gives, right? If you actually look at the different forecasts and account for the fact that a lot of forecasts are actually lower than our forecast of 75, a dollar at 70 cents would actually raise profitability from where the dollar was at 75 cents. So it's a move in the right direction. Wheat's still not, on average, penciling a profit, but you see canola being positive. And so that's to me is a good news. But if I move the Canadian dollar up now slightly to 80 cents and then to 85, you're seeing profitability being impacted in a negative way. That's what I want to emphasize is that 85 cents is sort of a threshold for us in which historically we've said, hey, at 75, the profitability is going to be tight. And that's going to put a bit of stress on some operations. So don't expect it to go there. But again, as I said, nobody knows exactly what this is going to be. So if there is a threshold to monitor, if we're seeing our currency move up in value throughout the year, as it approaches, hopefully it doesn't break the 80 cents barrier. And if it approaches 85, then that's what I would consider something that to be a bit stressful from a financial standpoint. So that's something to monitor. Do expect it, though, to remain at 75-cent range. So really, as just quickly for Central and Eastern Canada, if you look at other crops, corn and soy, similar kind of story, right? In the U.S. right now, I would say most observers are expecting a huge shift towards soybeans. I'm not so sure that I'm not convinced actually right now. I'd like to see the price differential between soybeans and corn being a little bit more tilted towards soybeans than what it is now to actually see a big shift towards soybeans. At current ratio prices between soybeans and corn, I'm not very convinced that we're going to get that huge decline in acreage for corn towards soybeans. I just don't see it. But anyway, so that's something that, again, we're going to learn more throughout the year. And that's something that we're going to have to monitor. But penciling some good profitability for soybeans at current prices or at future prices for 2017 under current assumptions. But and so this also is projections that the AAFC put out, first set of projections when it comes to acres in Canada. So expecting fewer acres of corn, big shift towards soybeans, and much of the same, actually a much bigger shift projected in the U.S. at this time. But as I said, I'm not necessarily convinced that we're going to see that in the United States, whereas these numbers for Canada sort of make sense to me. Okay, briefly in the protein market, what is going on? Well, it's a supply issue. As I said at the very beginning, I think it's supply driven right now. And that puts enormous pressure on demand to be strong. And what I'm trying to illustrate here is that you have the supply issue on the left-hand side, the domestic market in the middle, and the foreign market on the right-hand side. And we need a strong domestic market, and we're seeing retail prices fall at this time. I think there's more room for retail prices to fall, especially beef and pork prices. I don't think that we should expect chicken prices to fall this much. But there's been a room for retail prices to come down, and that's going to be supportive of domestic demand, especially on the red meat side of things. And demand out of China, for example, will continue to be strong. I don't expect 2017 to be as good for pork as it was in 2016. I think the herd is slowly rebuilding in China, and that we're likely to see imports slowing down a little bit. If we were to repeat our export performance in China for 2016, if we were to repeat that in 2017, that would be wonderful. I would say more realistic expectations is to be approaching that performance we saw in 16, but not necessarily exceed that. But still a very strong export market, and we need that because if you look at the North American level, so this is actually year-over-year increases in U.S. supply for the three main meat commodities. And if you look on the far right, well, you got some steady increase, no matter what commodity you're looking at, you got some steady increase in U.S. supply. And, when it comes to pricing, for us, it's a U.S. supply-driven pricing market. So, supply is going up. And in that environment, we're going to have to see strong demand. I'm confident that demand is going to be strong, but like I said, this is what we're going to pay attention throughout the year. Now, in terms of profitability, lots of different assumptions because I just wanted to show you a trend. Lots of different assumptions here, but what we're doing is looking at revenues over variable costs. Fixed costs, they depend on the scale of production. They vary from an operation to another, so I'm not putting fixed costs in there. So this is really revenues over operating costs or variable costs, and using future prices and assumptions about feed prices, assumptions about the Canadian dollar. That's the kind of profitability that we're looking at for 2017. So decent profitability. Scale is important. If you're larger than a 500 sow operation, you're going to move up that profit line up. That's going to be good. That's going to assure you a profit. At that scale, you're looking at, breaking even to a slight profit. Towards the end of 2017 right now, with futures markets are telling us that that's going to be a lot tighter. But overall, a decent year 2017, much in line, I would say, to what the 5-year average is or has been for hogs. So that's, I think, a more positive story, a positive outlook than what the last 6 months, especially of 2016, were telling us. Cow calf operations, profitability again over operating costs, because again, fixed costs are so different between across operations. Showing some room to cover those fixed costs. Profitability would be lower than what the previous years, but I would argue that in some ways it's not a bad thing. I think it's actually a very positive thing that we have some sort of rebalancing between the feeder market and the fed cattle market. And talking about that fed cattle market, same kind of deal here, using future prices, revenues over operating costs. We're showing a profitability in 2017 and a much better outlook for 2017 than what it was in 2016. So again, profitability, not necessarily profits that stand out as being really big, but above breaking even or slightly above breaking even is what we expect for 2017. Dairy, want to say a few things about dairy because there's a lot of different things going on in dairy. And the issue is really the price pressures that we've seen in the dairy sector versus the very positive story of consumption growth. There's actually an absolutely very positive story when it comes to dairy, and that's on the consumption side. But if you look at the trend in per unit milk revenues, well, the trend has been pointing downward, right? So that's what I'm trying to point out with the arrow there, right? So that's the standard milk price for the P5 pool. That's been trending down, slightly up recently. So if I'm trying to get rid of the up and down that you're seeing in the marketplace, I come up with a chart like this. Up, down starting in the middle of 2014. And right now what we're seeing is some sort of stabilization in the per unit revenue, which combined to growth in production is absolutely going to grow revenues in 2017. So this is a very positive outlook after years where we had some pressure in the system because of that surplus of skim milk. With what is likely to be coming online in 2017 in terms of new marketing arrangements to actually value the skim milk, the excess skim milk that we have because the market for butterfat's growing so much. I think overall, I think it's a positive outlook. At the very least, we're expecting trend in per unit revenue to actually be stabilized around the levels that we've seen towards the end of 2016. And with some growth in production, will be coming growth in revenues. And that's, I think, positive for dairy producers in general. Okay, I said I was going to at least get 15 minutes to get to the Q&A. So what's the bottom line? I'm going to say two things, right? I believe that the ag outlook is absolutely positive. Now, the point is not to be some sort of cheerleader and sugarcoat anything. I think we are, a few headwinds are coming our way. I believe that if we're maintaining, able to sustain, I have every reason to believe that we will be able to sustain farm revenues. I think that's a positive thing. I think we also have to have realistic expectations about the future, that the growth that we've seen for the last 10 years, well, maybe that's not necessarily realistic, but to be able to maintain farm revenues and slightly grow this over the next few years would be absolutely positive. And I'm fairly confident that we will be able to do so. And I'm going to leave you with this thought here. This idea of efficiency versus productivity. Short term, when we're seeing pressures on profitability, bottom line is you got to work on efficiency, right? You got to make sure that we're doing our best to control costs, work on your top three expenses, see what you can do to lower that cost structure of yours, and actually get that profit margin up a little bit at a time where we're seeing a bit of pressures on prices. So that's the efficiency part of it. And I would say is the short-term story. The long-term story is if we're going to see, we're seeing very little upside for prices over the next 1 year, 2 years, 3 years, then if we're going to grow revenues, that's going to come from growing production. So what can you do to make sure that your productivity is going up, make sure that you can use those inputs in a more efficient way, get your production up by not necessarily using more inputs, but making some adjustments on your farm, bringing in some more capital, bringing in some equipment, whatnot, at a time that we need to grow production to be able to sustain revenues. And I think that's going to be more volume-based issue in the next few years as opposed to a pricing type issue when it comes to revenues. I think if we're able to grow production, we're going to be fine at a time where, as I said, I expect a few pressures on prices. So I'm going to end here. 1 minute past my deadline, Brent, but I'm going to turn it over to you so that you can actually go through, help me out with a Q&A session. Thanks.
Excellent. Thank you, JP. I've been watching the questions as they come through, and there's a few good ones that I'd like to field back to you. You talked about a relatively modest, or the expectation of relatively modest increases in interest rates and debt borrowing costs. Can you put that in some kind of historical perspective? What does modest mean compared to what maybe we saw the decade before and the 5 or 10 years to come?
Yeah, so if you put that, so that's a very good question. If you put this historically, it was not unusual to see borrowing costs go up by 100 basis points and even more than 100 basis points, so a full percentage point, right? So 1%, 1.5%, even in some cases 2% over a span of 12 months. We've seen that in the past. What we are not used to see is a prolonged period of low borrowing costs as well as slow movements, right? I still think that we're going to have low borrowing costs at the end of 2017. Again, putting this on an historical basis, what I showed you actually, I think, had maybe 3 or 4 years of data. But if you go back further in time, you would see a lot more variability and a lot more movement faster than what we've seen recently. I still think we're going to see interest rates remaining low, but what I would caution about or against is perhaps the pace at which we could see some movement. I'm not expecting interest rates to be really high or borrowing costs to be really high at the end of the year, but pay attention to the pace at which those borrowing costs go up. And I think, for those of you that I'm not so sure that I should
Uh-oh.
back to that chart, but I did actually illustrate a bit of pace picking up towards the end of the year. I think that's the risk that we're facing when it comes to interest rates. And biggest mistake that I think somebody could do would be to actually just pay attention to what the Bank of Canada does, right? And wait for a signal from the Bank of Canada that rates are going to go up. Rates could be going up, and they're actually going up without a signal from the Bank of Canada that they're going to be raising their key interest rate. And I think that's the key lesson here is that we have, given the current context with everything that's going on with the U.S. and so on, have to pay attention to what's going on outside of our borders, not just from a commodity standpoint, but also from a financial standpoint. That's the one thing I would say in terms of keeping an eye on financial or interest rates in 2017.
So let's talk about the U.S. You reminded us that they're a big play here, 30% of what the GDP of our ag exports, and that you're not really nervous about that. But if U.S. exports became vulnerable, then where are our shifts in who's the replacement marketplace that we need to go to, and sort of how long does it take for our ag economy to do that regrouping? Are those customers that already exist, or how would we make that adjustment if that unfortunate circumstance took place?
Yeah. So yeah, good point. Good reminder as well that I don't expect this to happen. But you're right. I mean, at one point, if it does happen, we're going to have to look elsewhere. And reality with diversification, because we've been talking about diversifying our exports for a long time, right? It's easier said than done, especially when you have the largest, one of the largest, or the wealthiest, let me put it this way, wealthiest market right next to you. It's been a big advantage for us, right? But if you look at our crop exports, for example, right, 30% of our crops go to the U.S. So that means that there's 70% of our crops that go elsewhere, right? So those markets already exist. It's that it's a lot more spread out, right? Because after the U.S. being our largest market, then the second one, that market share goes all the way down to 10%, right? So it would be hard to build a market as important as the U.S. And it would take a lot of time. But I would be done. I don't have any reason to believe that it cannot be done. It's just that it would really take a lot of time. So diversification is ideally a really good risk management strategy when you're faced with a risk of, saying, a border in the United States a little bit less fluid or a little bit thicker than what we've seen in the past. But it's a lot easier said than done. And the reality with transportation, logistics, and so on. But I think we're heading in that direction. It's just that it could take a little bit of time. It could take a little bit of time. And one of the reasons I could expect also, the reason why I believe, and I'm actually fairly confident we're not going to see anything too drastic happen, is because the U.S. ag sector absolutely needs that border remaining open between not only Canada and U.S., but also Mexico and the U.S. So it's that reason that leads me to believe that we're not going to see a lot of changes between Canada and the U.S. But having said that, it's wait and see until we get more details about what the U.S. administration wants to do.
Well, staying on the trade topic, there's certainly more discussion about tensions between the U.S. and Mexico than there might be between U.S. and Canada. Does that open any kind of a trade opportunity for Canada direct Mexico in a different way? And I said maybe in the same context as we think about TPP blowing up, and we have relationships with Japan. Where are some of those other bilateral opportunities that will present themselves if those trade frictions play out that way for the U.S.?
Yeah, so, well, Mexico is an option for sure. I would say, though, that the mix of crops that we have is a bit to sell to Mexico is a bit different than the one that the U.S. has. So that raises a few questions as to how much we would be able to actually ship to Mexico. One of the things I'd point out is that you mentioned Japan. Japan's a premium market for us. It's actually a bigger buyer of canola right now than China, so it's a big market for us. Premium market as well, high quality, high value. So it's actually positive, and we can actually sustain our relationship and expand that relationship potentially with a trade deal, because we do have negotiations with Japan. We have negotiations with India that are, I would say, stalled. Look stalled to me. I mean, I'm certainly not privy to some of the discussions that are ongoing or maybe ongoing, but hey, we do have a framework to work with India. So it's actually very positive if we could get something done with India. Our prime minister is on the record as saying that he would like to get our trade relationship, improve the trade relationship with China. So all of these things, I believe, are going to get a little bit clearer throughout 2017. And so these markets that I just mentioned, to me, are markets that make a lot of sense, not from just a population standpoint, but also the income growth that we keep witnessing. I mean, people keep talking about China slowing down, but yeah, for sure it is slowing down, and from an industrial standpoint, it may be slowing down for businesses that are involved in industrial sectors, but you still have disposable income of the Chinese consumers that's growing, middle class is growing, and what they're doing is to buying more food and more high quality food. And so that's can only be positive for us if we're able to expand that relationship and develop that relationship going forward.
JP, you did an excellent job of stressing how the exchange rate between Canada and the U.S. has buffered Canada to a great extent and has kept us in the profitability zone, much more so than American producers. There's kind of two sides to that question. One is how long does that continue to go on before it really starts to change the fundamentals of the U.S. market, and that spills over to us in other ways? Clearly there's an opportunity in that just arbitrage for a little bit, but if the U.S. economy, if the U.S. ag economy starts to hurt, does that spill over into deals on equipment that kind of in reverse provide a buffer back so that equipment costs aren't quite as atrocious on the other side of the exchange for us? If this lasts for a long time, there's some other unintended consequences that play out.
Yeah, well, so it's a very good point. So the U.S. is the U.S. farm economy is actually in the middle of a significant downturn. I mean, if you look at the U.S. farm income in 2015, it came down roughly 25%. Don't have the exact number top of my head. And 2016, I think the most recent forecast is 8%. So you're looking at, over a span of 2 years, a drop in U.S. farm income of roughly 30%. Whereas what I just showed you is, 2015 we hit record high, and we're going to be a little slightly down in 2016. So the outlook or the situation has been totally different for us. So what are the implications of that? The huge downturn in the farm equipment segment. The currencies obviously raised the price of equipment coming from the U.S. for us. That has also shifted a little bit the mindset of producers that need equipment. I've been it's anecdotal in nature, but been monitoring some situations or seeing some situations in which equipment with very few years or very little use on them is actually being discounted quite high, and so that has made some interesting deals available for producers, and equipment dealers have revised their strategy, focusing on parts and services, and and that triggered as well a bit of consolidation. So if we're talking about uh, indirect impact of what is actually or what has actually occurred already in the U.S., absolutely. Some of the consolidation that you're seeing right now in the marketplace between, different farm input suppliers, that's, I think, the direct result of the slowdown in the United States. U.S. farmland values have started to drop already. So their farm economy is actually at this stage quite different than ours. And that's the reason why I'm pointing out the Canadian dollar as one of the ways that has helped us keep us in a relatively good spot or good position compared to the US. But for sure, there are some unintended consequences. If we're talking about the outlook for the farm equipment market, well, two things matter really: the price of equipment and income. Income's going to be flat at best, or slightly up, but not necessarily seeing a huge increase in income. And with the exchange rate basically staying at 75 cents and perhaps even lower, it's not going to lower the price of equipment. So I would expect that the weakness that we've seen in that market in 16 and maybe parts of 15 as well, that is likely to extend into 2017 as well.
Um, I'd prefer to send you a softball here, but I think I'll roll a hand grenade in. um, carbon, carbon trade, carbon credits. Have you made any kind of analysis about the potential impact here and where people should be cautious about how that might affect Canadian competitiveness?
The short answer is no. We haven't done anything. We're waiting to get the details out of different proposals at provincial levels. Um, this obviously will have an impact in the ag markets, but we got to wait for the details. And I know it's top of mind of a lot of producers, and I totally get it. But until we know the details of the different plans in each of the provinces and how this is rolled out, and also the industry's response to carbon pricing, because then it could create a few opportunities for some industries in the marketplace. My answer has been, hey, it's just too early to say. So we're just waiting to see if you'll get a bit more details of how this is going to be rolled out in each of the provinces, and perhaps we get a clearer idea of what is the ultimate impact of the ag sector on this.
You mentioned there's probably time to start considering if you had something on a floating interest rate to think about when you might fix. Any specific signals or sort of timing that would be flags for you for somebody to trigger that kind of thinking?
Well, as I said, so one of the things is certainly not to strictly monitor the signals that the Bank of Canada sends, right? So we have, if you're really if it's something important for a business, you have to monitor what's going on in the bond markets, what's going on in the U.S., for example, with their own interest rates, because that has lifted our interest rates as well here in Canada. So the last time that they did go up, and perhaps, they could go up as much as 3 times this year. So again, it's not necessarily an argument from me to lock in some rates at this time, but I would say that because the pushback that I get, and I totally get it, right? We've been living in a declining interest rate environment for multiple years, right? And so pushback you get when you're talking about locking in a rate or going fixed for a longer term is that, well, I've been leaving money on the table for a while now if, implementing a strategy like this. And then the response to this is yes, absolutely, because we were in the declining interest rate environment. We think that with borrowing costs are likely to go up, the pace at which they're going up is something to monitor for sure. And the best advice is to keep an eye on the financial markets, talk to your financial advisor, make sure that you have a strategy to monitor this. Like I said, I think the first place to go is the bond markets and looking at bond yields in general. And if you start seeing them move up, it means that the cost of funds for financial institutions is moving up as well. And that tends to trigger increases in interest rates ultimately. So this is the one thing that I would monitor.
JP, we've come to the top of the hour here. Maybe one last real quick question. You talked about kind of there's room for some profitability if we keep finding efficiency and productivity in the game. Maybe not the huge kind of increases that we had over the last 10 years. Do you have some thoughts about how the modest to small player works in this environment versus the producer who's on a steady growth strategy. What about medium-sized farms versus those that are scaling up rapidly?
Yeah, well, real quick, because we're running out of time, but scale matters. I mean, I'm not going to deny it. But having said that, one of the things that's different about ag markets today than what it was 10 years ago is that there's room for everybody, right? So if you have a smaller operation, maybe, face maybe a bit of a higher cost structure because of your size, then what are the products that you're producing, right? And so there's high value markets. I don't like to use the word niche necessarily, but there's some high value markets out there that smaller operations can actually leverage and get a premium out of. That premium tends to not be constant, right? If there's an appearance of a premium in the marketplace, well, guess what? Businesses are going to be going after that premium, and at the end of the day, that may sort of shrink that premium that existed in the first place. But the one thing we're seeing constantly is that new products are coming in, identity preservation of different characteristics of farm products along the supply chain are certainly being valued by the end user, by the consumer. So those are the things that smaller operations can do, actually. It's not just about cost, but it's also about value. How can you get the biggest value out of your products? And that's one of the things that I think smaller operations could work on.
JP, as usual, I appreciate your detailed answer to all those questions. Many good questions that came in. We're past the top of the hour. Appreciate everybody's. I see there's lots still logged on, and we'll have to wait for another opportunity to get the 2017 and a half or the 2018 update and trends. But as usual, well covered, from identifying where the noise is to implications of interest rates to trade deals to right into some of our specific commodities that we're each in.